So, welcome students. Today's topic is profit and loss account. We have already discussed in previous classes about the concept of income statement, financial statement, balance sheet, ledger, journal, trading account. So we have already have enough background about the accounting terms, and then accounting procedures. Today we are going to discuss about the profit and loss account, which is one of the very important statements which is prepared after preparation of trading account. So once we prepare the trading account, and trading account is prepared by transferring the records from the ledger to the trading account. And once trading account is prepared, then the next step is to prepare profit and loss account and balance sheet. So profit and loss account and balance sheet are the final outcome of the entire accounting procedure. So today we are going to discuss about profit and loss account. Profit and loss account is prepared to ascertain the net profit and net loss during an accounting year for a concerned. So it is related to ascertaining net profit. What is important is net profit and net loss made by a concern during an accounting year. In trading account, we have seen that we make trading account, we prepare trading account to ascertain the gross profit and gross loss. The difference between the trading account and profit account is that trading account is prepared to see the gross profit and gross loss made by a concern during an accounting year. Here, it is prepared to ascertain net profit and net loss. So what is the difference between gross and net? So when we take a trading account, then we take all direct income and expenses. Direct. Please note it down that it is trading account relates with the direct income and direct expenses, right? So when we say trading account, then it includes the items which are taken in the nominal account. Nominal account is the income and gain, and then profit, income and gain, and then expenses. So it relates to items which are included in the nominal account, both in case of trading account and in case of profit accounts. But in trading account, we prepare the trading account to know about the gross. So there we take all direct expenses, direct income, direct cost. Here, in case of profit and loss account, we prepare it for knowing the net profit or net loss. So all those items, all those direct costs which are included in the trading account is excluded while we prepare the profit and loss account. So profit and loss account does not include the direct expenses or direct income. So here we take net. Net means what? So it includes, there are two types of costs, direct and indirect. Direct income and indirect income. Direct revenue, indirect revenue. So in trading account, all direct income and losses, direct costs and revenues are taken. And here in profit and loss account, indirect revenue and indirect costs are taken. Expenses are taken. So we will discuss it later on. So a profit and loss account is prepared to estimate the net profit and net loss, as I have told you, and it is prepared after preparing the trading account. Okay, so how do we go for preparing a profit and loss account? So a profit and loss account starts with credit from the trading account. After preparing trading account, we go for preparing the profit and loss account. And we take information from the trading account, and then we go for preparing the profit and loss account. So first item is we credit. We take start the account with the credit from the trading account. in respect of gross profit or gross debit in the trading account. So from there we take the gross profit or gross loss and credit it into the profit and loss account. Then all indirect expenses and losses are debited to the profit and loss account. So then we take all indirect expenses. Indirect expenses are what? We pay salary, right? Then we pay for repair. So these are indirect costs and expenses. Likewise, we have the indirect revenue. So suppose we buy something and we get a discount of rupees 2,000. So that rupees 2,000 is indirect gain, indirect revenue. So it takes such kind of revenues and expenses, indirect. It means that all those expenses from income which have not been debited or credited to the trading account are debited or credited in the profit and loss account. So credit account, while preparing the trading account, we exclude the indirect expenses and revenues, and while going for preparing the profit and loss account, we take the indirect expenses and indirect revenues and exclude the direct expenses and direct revenues. Indirect expenses include all administrative, selling and distribution expenses, like I have already told you: salaries, rent and taxes, postage, stationery, insurance, depreciation, interest paid, office lighting, advertising, packaging, carry outwards. So these are the items of indirect expenses. Here, please note, please take care that it includes carriage outwards. Suppose only carriage is written. Suppose only carriage is written, then it means it is carriage inward. And in that case, carriage inward is a part of direct expense and it goes in trading accounts. But it is carriage outwards. So carriage outward is a indirect expense, and that is why it is written in the profit and loss account. So carriage inwards will go to trading account, and carriage outward is included, will be written in the profit and loss account. Losses includes item like loss by fire, loss by theft. These are indirect. Then I have already told you, even in the beginning we discussed that direct expenses are the part of trading and indirect are the part of profit and loss account. And I am repeating again. So be fix it in your mind that when we go for preparing profit and loss account, then it takes only indirect expenses. If there is any income and gain beside the gross profit, it will also be transferred to the credit of the profit and loss account. So please again remember that while preparing the trading account, we do not take any outside expenses other than business. So, or it includes only, the trading account includes only direct, means only those goods. It considers the revenue from those goods which are sold. So, and here it includes outside expenses also. Profit earned from outside business also. So it is profit and loss account, and if there is any income and gain besides the gross profit, it will also be transferred to the credit of the profit and loss account. If the total of the credit side exceeds the total of the debit side, it also has two sides, debit side and credit side. The difference represents the net profit. So if credit side is more, credit side exceeds, then we will say that there is a profit, and that profit is net profit. In adverse situation, means if the debit side is more, so that will indicate a net loss. So business can either make profit or make loss. So both cannot happen simultaneously, and if the credit side is more, then we will say that there is a net profit, and if debit side exceeds the credit side, then we will say that there is a loss, and we need to rethink about our business. This net profit or net loss is transferred to the capital account of the proprietor. Ultimately, it is the proprietor who is liable for the profit and loss gains. So Whether it is net loss or net profits, it is transferred to the capital account of the proprietor. In every business, we have two accounts, the proprietor's account and then the business account. So it will be transferred to the capital account of the proprietor. The net profit increases the capital. Obviously, if there is a profit, so it will increase the owner's equity, it will increase the capital. If there is a loss, then it will reduce the capital. So this is the format. This is the format of the profit and loss account. We have 4 columns here. First is particulars. Second, amounts. Again, particulars and amount. So the left side is, I have forgotten to write here. So it is, left side is debit side. We debit. We always write debit in the left side. So here it should be debit. Debit written here. So at this point, there should be debit. Okay. So just write it here down. It is DR. And this side, again, here it should be credit. So the format has 2 sides. First is debit and second is credit side. And I have written the items which are included in the format of profit and loss account as a debit or as a credit. So this list is an exhaustive list. You can see. First, what we do, we transfer the gross profit or gross loss from the trading account. So the first item is to gross loss transferred from trading account. So we have taken the balance forward, and if there is loss, then it has been depicted, it has been written in the debit side. So first item is the items transformed from the trading account, either in case of profit, gross profit or gross loss. So if there is gross loss, then it is debited, and if there is gross profit, then it will be credited, and it is written as to, then followed by gross loss transformed from trading account. So here you can write to gross loss, and then the amount can be written. Here it is profit, so by gross profit transformed from trading account, and then write the amount. Then second is management expenses. So management expenses include several items, and first is salaries. So if all salaries are the part of expenses to carry out the business, so salaries are debited, and it is debited the rent, rates and taxes. So rent, rates and taxes, these are all the part of expenses, and these are the part of indirect expenses, so it is written here. Then stationery and printing charges, telephone expenses, legal charge and law costs. Sometimes we need to hire a lawyer to fight a suit. So that is written here. Then entertainment expenses. Sometimes we pay our employees certain types of perks to entertain them, to motivate them. So such expenses are written here. Then insurance premium. So insurance premium is also the part of indirect expenses for a business, and it is written here. General expenses, audit fees. So if these items appear in any of the trading account, then these items are debited in the profit and loss account. Likewise, credit side, interest receipts. Interest received, suppose we have fixed some cash in the bank and we get interest on that amount, so that is the part of indirect revenue, and it is or a part of indirect income, so it is written in the credit side by interest received. By discount received. So suppose we have purchased something and a discount is given to us, so that will be credited by, and then we will write discount received. Similarly, commission received, income from investment, then rent, apprenticeship, miscellaneous income, net loss transferred to the capital, and then lastly by net loss transfer to the, we will prepare, we will see the differences between the both sides, and if there is a loss, then we will write by net loss transfer to capital account. It will be transferred to the capital account of the owner. So more items are there in debit side. All selling expenses. So we have management expenses. Then another category is selling expenses. Selling expenses include advertising, salesmanship, salesman's salary, selling commission, brokerage, traveling expenses, free samples. So these are bad debts. Debt नहीं बोलते हैं, debt बोलते हैं. So it is bad debts. All these will be the part of the credit side of a profit and loss account. Then to distribution expenses, then comes the third category is distribution expenses. So we go for storage and then marketing. So all the expenses involved in the distribution of a commodity good comes under the distribution expenses, and it includes warehouse rent, carriage outward. Already I have told you, warehouse insurance, packaging expenses, delivery one expenses. So these are all the part of expenses, and these nominal account, and these are indirect expenses, so they are credited. Then depreciation, maintenance expenses are there. We need to maintain our machine, equipment, plant. So it is there. It is the it credited. Then depreciation of assets. Assets also depreciates when we buy a asset. So depreciation of assets is the part of indirect expenses, and that is why it is credited here. Then fourth category is finance expenses. So discount on bills, discount allowed. A firm also gives discount sometimes. So those are the part of expenses. So discount allowed, interest on capital, and then interest on loans, loss by fire, or any natural hazard, other calamities. So these are the part of expenses, and the firm has to bear it. And these are indirect cost, indirect expenses, and therefore these all items are credited in the profit and loss account. And then at the last, we make all the credits, all the debits, and if there is profit, then to net profit transfer to capital account. So the last column of the debit side is written as to net profit transferred to capital account, and it will be transferred to the capital account of the owner. If there is loss in the beginning, you have seen, so that will be credited, and it will again be transferred to the capital account of the owner. So whether it is profit, net profit, or net loss, it is transferred to the capital account of the owner. So ultimately, it is the capital who has to bear the profit, who has to bear the loss. Then what are the advantages of profit and loss account? So we prepare profit and loss account to ascertain the net profit and net loss. Ultimately, it is the net gain, net profit, net loss in which the proprietor is interested. He should have net profit or net loss. Gross always is not the right indicator of profit and loss. So the net result, profit or loss, revealed by this account is an index by which progress can be measured. So it helps in assessing the true progress, real progress of the business. If there is a net profit or net loss, on that basis we can say that business is progress free or the business has failed to progress. Then the second is various expenses can be effectively controlled by comparing various expenses year by year. It is year by year. So you have seen in the profit and loss account that we include all the items, all exhaustive list of indirect expenses. So we have the record of and the amount of each item wise expense, and we can compare among those, and then we can plan, we can think what are the items where we can make adjustments, where we can rethink, we can reallocate our resources and efforts to improve the profit, because the ultimate objective is to enhance the profit, to improve the profit. So by comparing various expenses, we can effectively control the items which are uh, incurred in excess, where the control is possible. So we can minimize those expenses, those cost items, and it will ultimately help in improving the profit, minimizing the loss. So it is the second advantage. And then third is profitability is the basis and help in planning of action. So it is the motive of the business of the proprietor that it should earn profit. No business is started for the loss, with the motive to incur loss. So there is intention, inherent intention, that there should be a profit, and this is the definition of the business. Any activity that is started with the motive to earn profit is a business. So profit is the ultimate motive, and therefore on the basis of the true picture, you have the net loss, you have the net information about the loss or gain incurred by the business during the last year, during the last previous accounting year. So you can compare the item-wise expenses, you can eliminate, you can reduce those expenses which can be where there is possibility to reduce, to eliminate, and then by rethinking, replanning, the business can be converted into a profitable venture. So profitability is the basis and helps in planning of action. So this is very important. And then what is the difference between trading and profit and loss account? So we have already discussed in between, but here it has been summarized, it has been given in a summary form. So trading account, the first section of revenue account is trading account. When we go for preparing the revenue account, revenue, you know. So the first is a revenue account, and then the profit and loss account is the second section of revenue account, which is known as profit and loss account. So in a revenue account, the first item is, the first section is trading account. And in revenue account, the second item, second section is profit and loss account. Both are the indicators of profit or loss of a business. Profit or loss made by a business. And it is the revenue, means the income received from the sales, and the cost, the difference between revenue and cost gives the profit or loss. So it is the part of revenue account. Then the second, it is prepared to know only the result of trading. In trading account, we simply note down the direct expenses with the sale of the goods and the direct revenue earned from the selling of those goods. So it only takes the business part, only takes the trading part. Whereas in case of profit and loss account, it's prepared to know the ultimate result of the business. So apart from trading business, the business also makes certain expenses, and we have already discussed those expenses item, and then earn income from other sources like interest, etc. So in profit and loss account, those items are included, whereas in trading account, only the items which are traded are included. Third is, it deals with purchasing and manufacturing cost of goods. Trading account deals with purchasing and manufacturing costs of goods only. Whereas in case of profit and loss account, it deals with administrative expenses. Already you have seen selling expenses, distribution expenses. So there is a difference between the trading and profit and loss account, and this is the another third difference, that in trading account only purchasing and manufacturing costs of goods are considered, whereas in case of profit and loss account, it deals with the other items of expenses also, like administrative, selling and distribution expenses. And then the fourth and last is balance of this account is transferred to profit and loss account. When we prepare trading account, the balance after the completion of the year, accounting year, is transferred to the profit account. So the balance from the trading account is the opening, is the first item in the profit and loss account. Whereas the balance of the profit and loss account is transferred to the capital account of the proprietor. We have discussed it. So when we prepare profit and loss account, the final balance, profit or loss, whatever has happened, is transferred to the capital account of the proprietor, of the owner. So this is all about the profit loss account and the difference between the trading and profit loss account. We will see in the next class balance sheet and some examples on the profit and loss account. So we will discuss it in the next class. So this is all about we have discussed so far the trading and profit loss account, and profit and loss account is prepared to ascertain the net profit and net loss, whereas the trading account is prepared to ascertain the gross profit and gross loss. And the balance of the trading account is transferred to the profit and loss account, and profit loss accounts balance are transferred to the owner's equity. So this is all about. Thank you very much. Thank you all.
Thank you, sir.
You're welcome.